Hello, welcome to the third video in our series on financial accounting. Up until this point, we have reached the unadjusted trial balance. So now we move to making some adjustments. We're going to talk about the adjusting process in a bit, but I want to bring up the accounting cycle with you again. Let me call that up on the screen. Find it, call it up. Okay, so on my screen, you'll see the accounting cycle. And we focused on the first couple of videos, analyzing business transactions, journalizing them, posting them to our ledger. We use T accounts for that. And we arrived at our preliminary trial balance. Now, in this video, we're going to be talking about journalizing internal adjustments, posting them to a ledger. We're going to use a worksheet to facilitate that. And we're going to arrive at our adjusted trial balance. Then we'll prepare our financial statements. So we're focusing on this section of the accounting cycle. Again, we're going to journalize some internal adjustments, post them to our ledger. We're going to use a worksheet to facilitate this, as I mentioned. We're going to prepare the adjusted trial balance, and then, bam, we can do our financial statements. Okay, so stay tuned as we go through this process. So I'm going to stop sharing my screen for a sec. Okay, so why do we make internal adjustments? Why do we need them? Okay, well, during the course of the month, you're going to be recording business transactions. And let's say you bought an insurance policy. It was an annual insurance policy, and that's going to expire over 12 months. So every month, that insurance policy is expiring 1 month at a time. Well, the insurance salesman's not going to come knocking at your door and say, hey, listen, make sure you write off 1/12 of this policy as it expires. No, they're not going to say that. So you have to remember to adjust this insurance asset called prepaid insurance, because you're prepaying it up front for the whole year. You have to realize you need to make an adjustment to write down that insurance policy by 1/12 of the value for that 1 month. So over the 12-month time, that policy gets written off 1/12 at a time, 1 month at a time, till it's all expired. Okay, so that's one example of an adjustment you're going to make. Another one, you buy some supplies. They're going to be used in the business. So we bought some supplies. We're going to use them in the business. At the end of the month, we go take our count of supplies. And we realize we have, let's say we bought $1,000 worth of supplies. And at the end of the month, we realize we only have 400 remaining. Well, we use 600 of those supplies. So when you use up an asset, that turns into an expense. So we have to expense the cost of those supplies that we use to run our business, the $600. Okay, so those are some examples of some adjustments we need to make. They all revolves basically around a couple of concepts. One is revenue recognition and expense recognition, matching principle. Okay, the accrual concept of accounting. We accrue expenses as they happen, even though we haven't paid for them yet. Okay, so these adjustments will evolve around it, and there's no money exchanging. There's no money involved, no cash entries are involved in these adjusting entries. So all internal adjustments we make to basically chew up the accounts, chew them up, make sure they're correct. Because without these adjustments, we will overstate or understate revenues or expenses for the period. And some examples of an accrual might be at the end of the month, you may have some unpaid salaries, wages, because most oftentimes wages are paid a week or two after the fact, after they're earned by the employee. So if let's say the month ended on the 28th, the last pay period was the 28th, but you have the last 3 days of the month that will be paid the following month, 29th, 30th, and 31st, be paid in the next month on the next check. Well, you have to accrue those 3 days of payroll on the books. That's another example of an adjusting entry. You have to make an entry to put that expense on the books in order to match the expense with the period. Okay, the expense happened in that month, the last 3 days of the month. You want to make sure the expense gets recorded on the month they are incurred or they happen. Okay, so you make an accrual. Accrual is just a fancy word of putting it on the books. We're going to make an entry to put the amount on the books. So we're going to walk through a series of these adjustments. I have a spreadsheet I'm going to share with you as we walk through going through the process. We're going to look at an unadjusted trial balance. We're going to start from there. Then we're going to make some adjustments, journalize them. We're going to post them to a worksheet that will serve as our general ledger. And then we're going to add across to get our adjusted trial balance. And then we can prepare our financial statements. So I'm going to share my screen with you all. And we're going to walk through this process and let's get at it. Yeah, accounting's fun. So there's my screen. You should see my screen up on your computer. Okay, so let's walk through it one at a time. So you'll see up here, we have the unadjusted trial balance. This is from all our business transactions that we've journalized, like we did for the first couple of videos. We arrive at our unadjusted trial balance. Okay, from that, we're going to make these adjusting entries. So again, we have all our balances here. This is from all our journalizing, posting, and into our ledger, and we get our unadjusted or our preliminary trial balance. So here we have some adjustments needed. We have unexpired insurance at the end of the period, which is December 31st, is $1,600. What does unexpired mean? Okay, well, insurance expires over time. So we have some prepaid insurance on our books. We bought some insurance policies for our companies. We paid $6,400 worth for the period. But we have some of that that's expiring. Insurance expires over time. Well, how much is unexpired? $1,600 is unexpired. That means of the $6,400, $1,600 didn't expire. So the difference between $6,400 that's on our trial balance and what should be on our trial balance of $1,600 is our adjusting entry. We have to make an adjusting entry for $4,800. Okay, the next one, B, supplies on hand at the end of the period, $2,770. Supplies on hand. That's what we counted. That's what we still have out in our storeroom. But we have on our books $4,500 in our preliminary trial balance. So we have to make an adjustment for the difference. We have to write the supplies down to what we have on hand, what we used up. And that difference between these two numbers, the 4,500 and the 2,770, is $1,730 we need to make an adjustment for. Okay. Then we have transaction C, depreciation of the building for the year, $6,300. Okay. Well, we have building on the books, but we need to make an adjustment to write the asset down. Well, the accountant said, you know, this accounting stuff's getting too easy. We need to mix it up a little bit and create some new accounts. That's not really what they said, but it seems like that. Well, we have an account called accumulated depreciation on buildings, which is a contra asset account. What means contra asset? It means it's a contrary balance. You know, all assets have a left side balance. Well, the accumulated depreciation has an opposite balance or a contrary balance. They call it a contra asset account. These two accounts are inseparable. Building and accumulation of depreciation on the building are inseparable, right? Like peanut butter and jelly, like whatever, Forrest and Jenny, whatever. They're inseparable, like your textbook in the weekends, okay? Inseparable. These two accounts always go together, okay? So as we write down the asset as it depreciates, we're going to put the depreciation in this accumulator, the accumulated depreciation. That's where the depreciation is going to accumulate. So if we always want to know what the book value is of the building, we will take the cost of the building minus the accumulated depreciation to get the book value. The same holds true for equipment that's depreciated as well. Land is the only capital asset, and we'll talk more about capital assets in another video coming up in the future. But land is the only capital asset, a fixed asset that will not be depreciated. It stays on the books at cost for as long as you have it. Okay, so we have to make some adjustments: depreciation on the building, depreciation of equipment, and these amounts are given to you right now. In a future video, we will show you how to calculate this depreciation. Okay, all depreciation is a systematic write-off of the asset over time. It's depreciating over time. But we'll get into some of those calculations at another video. Okay, then we have transaction E, some rent unearned at the end of the period, $8,500. Okay, rent unearned. Well, if we look at our trial balance, we have unearned rent on our books of $12,500. Okay? Unearned rent, that means we get paid in advance from our customers. we haven't earned anything yet when we get paid in advance. Well, at the end of the month, at the end of the period, December 31st, we see that we've only unearned $8,500. So we need to make an entry for the difference to write this $12,500 balance down to what is the new unearned amount, $8,500. So we earned $4,000 of this unearned rent at the end of the period. So we have to make an entry to do that. Okay, then you have salaries unpaid for the last 2 days of December, $1,800. Okay, these salaries will be paid in January. But if we don't accrue them or put them on the books, we'll understate our salaries expense by $1,800. So we're going to make an entry to increase our salaries expense and put a salaries payable on the books. We'll see that. And when I come down to the entries, we do that in a minute. Okay. Then transaction G, service revenue earned, but will not be billed until January, $15,000. So here we have this contract with our customer. Let's say it's $30,000. And we're not going to bill it until January. And we're going to perform half of it in December and half of it in January, and we get to bill the client for $30,000. Well, if we earn half of it in December, we need to make the entry to accrue or put on the books the $15,000 that we earn, half of the contract. You recognize revenue when it's earned. That's the important part about revenue recognition. You recognize revenue when it's earned. You recognize expenses when they're incurred and revenue when it's earned. So we're going to make entries for these, all these adjustments here. Okay, all 7 of them. Okay, down below in the general journal. So we'll come over and do that. And we're going to journalize these transactions for the period. We're going to complete the worksheet and prepare our financial statements. So let's go down, let's do it. So let's take a look at the first one. So the first entry is the unexpired insurance at the end of the period is $1,600. Again, so what's the process for adjustments? We look at our trial balance, it shows $6,400, and we know it has to be $1,600. So we'll make an adjustment for $4,800. Okay, $4,800. The difference between the $6,400 on our trial balance and the $1,600 that's unexpired. Okay, the account will be, well, prepaid insurance is the asset going down. So we're going to find the account called prepaid insurance. That's the asset that's going down. And assets, when they go down, they go on the right side. Okay, assets increase on the left, they decrease on the right or credit side. So as insurance expires, what do you think that turns into? When an asset is used up, it turns into an expense called insurance expense. We find that account called insurance expense. So we have a debit to insurance expense. Expenses are always debited, always on the left side, because expenses are an equity account and expenses always reduce equity. So they're always on as a debit on the left side. So there's our first entry. Okay, we recorded the entry, or we journalized the entry to record the expiration of some of our insurance. Now transaction B, supplies on hand, $2,770. So again, we take the difference between what's on our trial balance, I'll put the formula in here, 4,500 minus the 2,770, oops, 2,770. We have a difference of $1,730. Okay, $1,730. That's the adjustment. That's the amount of supplies we used up. And as we used up the supplies, we have to show the supplies account going down by $1,730 because we want to write this asset down called supplies by $1,730 so that the on-hand balance will be $2,770 when we get done making this journal entry. And as we use up an asset, what does it turn into? An expense. So we find supplies expense right here, $1,730. Okay, moving along. Let's keep going. The third entry, we have the depreciation on the building, $6,300. So we find an account called depreciation expense on the building. And it's an expense. As the building is written off, that's an expense, depreciation expense, $6,300. And we know we can't credit the building directly. We have to use the contra asset account called accumulated depreciation on the building. That's we accumulate our depreciation. Okay, accumulation. It's almost like anyone in the Northeast, we know what accumulation is, especially in the winter when the snow starts accumulating. Anyway, depreciation accumulates the same way, right? Except depreciation doesn't melt in the spring. Okay, let's keep going. So the next entry, depreciation of equipment, $17,600. Again, we find the account called depreciation on the equipment. Whoops, depreciation, where is it? Right there on the equipment. And that's $17,600. And we find that contra asset account called accumulated depreciation on the equipment, $17,600. Okay. Depreciation expense, accumulated depreciation. That's how you make the adjustments for depreciation of your property, plant, and equipment, or your fixed assets, capital assets. They all mean the same thing. Okay. Let's look at the next transaction. Again, we looked at it. I've talked about it already. The rent unearned at the end of the period is $8,500. We have on our books $12,500. We want it to be $8,500, so we'll make an adjustment for $4,000 to write that asset. Write that liability down. So the liability is going down by $4,000 because we've earned it now. So we know that a liability called unearned rent has a credit balance. So if we want to show it being reduced, we go opposite, right? So we have to put on the left side $4,000 unearned rent as that liability is going down. Unearned rent. Let's find it right here. Okay. And then it's turning into, as we earn it, rent revenue. Now we've earned that rent revenue for the period. Okay. And now we come to our next adjustment. Salaries unpaid for the last 2 days of December, $1,800. So these are salaries. There's going to be salaries and wages expense, and we need to put that on the books. So let's find it. Salaries and wages expense for $1,800. And since we haven't paid it yet, it's a payable. It's owed to our employees. So we have something called salaries and wages payable, $1,800. Okay. Lastly, we have our last adjustment. Service revenue earned, but will not be billed until January, $15,000. So we've earned something. So we've earned $15,000. Let's put the 15,000 in first and see what accounts we're going to use. Well, if we've earned something, we have to find an account that sounds like something earned. Revenue. What do we have for revenue? You've got a revenue account here somewhere. Wait, there's supposed to be a revenue account here somewhere. Where is it? Oh, would you look at that? There isn't one. We'll have to put one in there. I'll type one in. Okay. Type one in there. Fees earned. Well, service revenue. We'll call it service revenue. This one in there. Is it service revenue? Yeah, right here. Boom. There it is. Right over it. Service revenue. Okay, service revenue. And we haven't got paid for it yet. We're going to expect the money in the future. So we have something called accounts receivable. Okay, accounts receivable. Okay, so those are our adjustments. We have, you notice most of the adjustments are revolving around expenses, right? Insurance expense, supplies expense, depreciation expense, and then salaries and wages expense and revenues, rent revenue and service revenue. You know, cash is not involved in any of these transactions. Why? They're all internal adjustments. You're not transacting with anybody outside of the company. It's all internal adjustments to make the accounts, you true up the accounts. So let's take these adjusting entries now, and we're going to post them to our ledger. We're going to use a worksheet to do that. So here's our adjusted trial balance worksheet. And we have all the preliminary balances from our trial balance up above that we saw earlier. All these balances here from our unadjusted trial balance are now on our worksheet, as we use this worksheet to help us walk through this adjusting process. So we're going to post in these columns here. We're going to use this as our ledger, if you will. We're going to post these entries, the adjusting entries, into our worksheet. So the first entry, let's go over to it, was the insurance expense, $4,800, and prepaid insurance, $4,800 credit. So let's find out the prepaid insurance going down by $4,800. Let's post that into our ledger, if you will, and using a worksheet. And find insurance expense. We're going to put that on our books. We're posting that to the insurance expense account, $4,800. Okay, just posting them up. So let's see what we have here. Next one is supplies expense, a debit of 1730, and supplies a credit of 1730. So we find the supplies account, we'll post that credit 1730, find supplies expense, and post the debit of 1730. Okay, all we're doing is posting the entries that we already journalized. Then depreciation and accumulated depreciation on the building, $6,300. Let's find those accounts. Let's see, accumulated depreciation, 6,300, and depreciation on the building, 6,300. And then we have depreciation on the equipment, $17,600. Find the accumulated depreciation, 17,600. And we find the depreciation expense on equipment, 17,600. And then we have our unearned rent going down by 4,000. We're going to post that into our unearned rent account, a debit of 4,000. Find our rent revenue account and post that credit of 4,000. Then we have our salaries expense. We post that debit of 1,800. And our salaries and wages expense payable. Now we find out we post that credit of 1,800. And lastly, we post this accounts receivable debit of 15,000. $15,000. And then we post the service revenue credit of 15,000. Okay. So we've just posted all our entries onto this worksheet. Again, so here's our preliminary trial balance, what we started with. Now we just posted all the, all these adjustments we just posted to our worksheet, again, which is serving as our general ledger. Just makes it easier to see how these entries impact the books. So now what we're going to do is we're going to add it across. Okay. So we're going to take our preliminary trial balance plus or minus these adjustments to get our all important adjusted trial balance. Once we get our adjusted trial balance, we can do our financial statements. So let's do that. So we had a balance of 12,500 for cash, but we made no adjustments. So the balance is 12,500. Same with accounts receivable. We had we have an adjustment. So we start out with 40,400. Now, do we make any adjustments? Yes, we made an adjustment of $15,000. A debit plus another debit is a larger debit. So our balance is now $55,400. Now, supplies, we had 4,500 from our preliminary trial balance, but we credited 1,730. That is subtracted from the 4,500, and look what our balance is, 2,770. That look familiar? It better look familiar because that was the supplies on hand at the end of the period, 2,770. Okay. So now we come to our prepaid insurance. We had $6,400 on our books before adjustments. After adjustments, we took 4,800 away as a credit. A debit minus a credit equals a smaller debit. Now we went from $6,400 down to $1,600. Again, that is the amount of unexpired insurance that we saw previously up above in those adjustments. Now land is stay on the books at $150,250, no adjustments. Building the same way, $250,700. Now accumulated depreciation has a credit balance of $100,280. We added another credit to that, so now it's a larger credit. Now it's $106,580. Now the equipment still has the same balance, $176, no adjustments to equipment. We made the adjustments instead as we depreciate equipment to the accumulated depreciation account. So we take the credit balance plus another credit of $17,600. Our new balance is $123,200. We made no adjustments to accounts payable. We did make an adjustment to unearned rent. We had $12,500, but we debited $4,000. Our new balance is $8,500. Okay, and then salaries and wages payable, we had no balance, but we did credit $1,800 to accrue those last 2 days of the period. So now we have a balance of $1,800. Common stock, we still have $125,000. Retained earnings, we still have $215,870, and dividends, $25,000. We didn't make any adjustments to those. Service revenue, we had 526,900. We made an adjustment for 15,000. So our new balance is 541,900. And then rent revenue, we had nothing before adjustments. We made an adjustment of 4,000 to recognize the revenue that we earned, rent revenue for the period. So now we have 4,000. Now we have all our expenses. Salaries and wages expense, we had 316,200 plus the 1,800 we debited as an adjustment. We have 318,000. We made no adjustments to utilities. We made no adjustments to advertising expense. Now depreciation on building, we had 0, but we made an adjustment for 6,300. So our new balance is 6,300. We made no adjustments to repairs expense. We had no insurance expense, but we made an adjustment of 4,800. So there's our balance of 4,800. The same with depreciation expense. We had nothing, but we made an adjustment of 17,600. And supplies expense, same thing. And then lastly, miscellaneous expense, we did no adjustment to it. So we have 26,700. And you can see our balances, all these balances equal. Left equals right. It's a beautiful thing. I just want to call your attention to one thing before we go into the financial statements. I color coded all these accounts over here. There's a reason why I color coded them. All these accounts are assets. All these accounts in this color are liabilities. All these accounts are equity accounts. And the ones in green here are revenue accounts, and all these in tan, or whatever color that is, are expenses. And this is a typical order of accounts. Let's call it a chart of accounts. Every company has a chart of accounts. It's basically in the same, pretty much the same order. Assets first, then liabilities, then equity, then revenue, then expenses. And why do I bring this up? Well, it's important to know, but also if you don't understand what an account is, just by where it falls on the trial balance is a good indicator of what type of account it is, because every company usually follows this structure: assets first, liabilities, equity, revenue, and expenses. So you can see expenses are always going to be at the bottom of your trial balance. Assets are always going to be at the top of your trial balance, et cetera, et cetera. Okay. All right. So let's take these balances here from our adjusted trial balance. These are the ones we want, these balances right here. And we're going to explode them out or prepare our financial statements. Okay. Sounds kind of explosive, explode them out. We're going to prepare our financial statements. So we're going to do first, this is how we do them. We do our income statement first, then we do a statement of stockholders' equity, and then we do our balance sheet. Okay, so let's look at the income statement first. And we do that, and I'll show you why we do that in this order. So the revenues, we're going to pick all our balances off of our adjusted trial balance. This is the all-important statement that we need, the adjusted trial balance. So we're going to grab our revenue from that. So our revenue for the period is $541,900. Our rent revenue for the period is $4,000. So our total revenue on our income statement is $545,900. Now we take all our expenses off from our trial balance. Again, they're at the bottom part of our trial balance, 318. Whoops, 318. We can copy all that down. Those familiar with Excel know that if you, where that white cross turns into the black cross at the corner, you can drag that down all the way down and grab all these expenses here. So all these expenses over here, or you could copy and paste them in either way. So you get the totals, put an equal sum here and sum up all these expenses. And you get 505,130. If you don't like these little green arrows here, you can just ignore errors. There's no errors in there, but Excel thinks there are, but there aren't any. So the company, if you, let's put an underline here. So the company had revenue of $545,900, expenses of $505,130, their net income of $40,770. $40,770. That's how much money they made. Revenue minus expenses. Well, that is important to do because that becomes an input into our statement of stockholders' equity. Okay, so we take our beginning balances of common stock, which we know common stock account is right here. Okay, so $125,000 125,000. So we want to grab that amount. Okay, retained earnings is from our trial balance as well, 215,870. These are our beginning balances because we haven't made any adjustments to them. We only make adjustments to retained earnings at the end of the year. We'll see that in the next video when we do our closing process. Right. So for now, you're going to grab the retained earnings right from the adjusted trial balance. That's your beginning balance. In the retained earnings, what impacts retained earnings? Revenue minus expenses and any dividends. Well, the company pay out any dividends? Yes, they paid out $25,000 of dividends. So we grab the dividends account, and there we show our retained earnings balance of $231,640, and our common stock still on the books at $125,000. Just as a point of note, everything below the retained earnings line on the trial balance, if you see the retained earnings line on the trial balance of 215,870, everything below the retained earnings on a trial balance impacts retained earnings. You notice the dividends and the revenue minus expenses. Okay. So now we have our two of our three statements done. We have our income statement first, statement of stockholders' equity. Now we can do our balance sheet, which is the accounting equation with all the accounts listed to show our assets equaling liabilities plus equity. So we have our cash account. So let's find our cash account, 12,500. Then we have our accounts receivable, 55,400. Then we're just grabbing them right from our trial balance. Supplies, prepaid insurance, your land, your building. Okay. Now you have less your accumulated appreciation. Why is that a negative on the balance sheet? Because that's a contra asset account. Remember, all assets have debit balances. Your contra asset has a contrary balance, so it's going to reduce your assets. Okay, your equipment, it's going to be right here, and then you have your accumulated appreciation on equipment right there. So we have total assets of 419,440. Okay, now we come down to accounts payable. We're going to grab that amount off our trial balance here, which is this account here. Okay, unearned rent, which is the $8,500, and then salaries and wages payable, which is the $1,800. Okay, again, all these errors, these little flags bother me. Get rid of them. Okay, so total liabilities are $62,800. Again, I can scroll back over it so you can see the account captions, but all these accounts here are our liabilities. So we took these balances, 52,500, 8,500, and 1,800. They show here on our balance sheet. Okay. So now we have common stock. Where we get that information? Right from our stockholders' equity statement. Well, actually, you can get it from there, or it's probably better just get it from the trial balance, right? Either way. Now, retained earnings, we can't take the trial balance retained earnings because we have all these factored in dividends, revenue minus expenses. So we're going to take it from the statement of stockholders' equity. And you notice that when we do that, that our assets of 419,440 equal our liabilities and stockholders' equity of 419,440. Okay, it's a beautiful thing. All right, so that's how you put your statements together. Again, you always start with the income statement because the income statement net income becomes an input into your stockholders' equity statement. And then you do your stockholders' equity statement because your retained earnings balance becomes an input into your balance sheet. So they're all interrelated. So if you do them in this order, it'll all flow nicely. Okay, so that's it. That is it for the demonstration for the adjusting process and preparing your financial statements. I hope this video helps you, and the next video will be the closing process, where we do our closing entries and prepare our post-closing trial balance. So that's it for now. Signing off. I'll see you next time.